Welcome to Interactive Investors Super 60 Fund Finder.
The long-term outperformance of smaller companies versus larger companies is a powerful investment trend. The numbers speak for themselves. Research by the London Business School found that £1 invested in 1955 in UK smaller companies would have grown to £7,933 by the end of 2020. In contrast, £1 invested in UK large companies over that 65-year time period would have grown to £1,054. So one of the main reasons is due to their size. Smaller companies have more room to grow and therefore potentially greater ability to produce higher returns for shareholders. Smaller companies are largely neglected. Most institutional investors, as well as some fund managers, tend to shy away from smaller companies on the grounds that the shares are too illiquid. In addition, most analysts tend to stick to larger companies as they are easier to research and more widely owned. But it's important to be aware that smaller companies are riskier than larger companies and are much more vulnerable to investor sentiment turning quickly sour. A long-term investment horizon, therefore, is crucial. In Interactive Investor Super 60 list, 3 examples of funds and trusts that invest in smaller companies are the Diverse Income Trust, Henderson Smaller Companies Investment Trust, and the Artemis US Smaller Companies Fund.
The big question.
Mid and small cap funds are generally considered to be more riskier investments compared to large cap funds, so should be used mainly for satellite allocation. For example, for adventurous growth investors, this fund should not have more than 30% allocation in the overall portfolio. Small companies can be more affected by changes in the economic environment. During recession, small cap stocks can see larger declines in price, whereas in economic recoveries, small caps can rise in price faster than larger caps. Investors who want to take advantage of the price volatility can choose to buy more shares of small cap funds during market corrections. However, it's important to keep in mind that market timing is very risky for most investors, so spreading your investments over a large of different asset classes, regions, sectors, and market cap is the very best way to be diversified and minimize any losses for each individual fund in your portfolio.